Hey everyone, and welcome back to the channel. Today, we're diving deep into a topic that trips up so many new traders: technical indicators. Which ones actually work? How do you use them without cluttering your charts and confusing yourself? By the end of this video, you'll have a clear, simple framework for using some of the most powerful and time-tested indicators out there. So, you open up your charting software, and you're hit with a massive list of indicators. It's overwhelming, right? You've got oscillators, trend indicators, volume indicators, ... It feels like you need a PhD just to get started. The truth is, you don't need hundreds of them. In fact, using too many, what we call indicator overload, can lead to analysis paralysis, where you have so much conflicting information that you can't make a decision. The secret isn't to find some magic, hidden indicator that no one knows about. The secret is to master a few of the most reliable ones and understand what they're retelling you about the market's behavior. The most popular indicators are popular for a reason. They work. Millions of traders, from retail investors to huge institutional funds, are looking at the exact same signals. This creates a sort of self-fulfilling prophecy, making these indicators incredibly powerful. Let's start with the absolute foundation of trend analysis: moving averages, or MAs. A moving average smooths out price data to create a single flowing line, making it easier to identify the direction of the trend. The two most common types are the simple moving average, the SMA, and the exponential moving average, the IM. The SMA gives equal weight to all prices in its calculation period, while the EMA gives more weight to recent prices, making it react faster to price changes. So how do we use them? The most basic way is to see if the price is above or below the moving average. If the price is consistently trading above a key moving average, like the 50-day or 200-day, it suggests an uptrend. If it's below, it suggests a downtrend. Another powerful technique is the moving average crossover. This is when a shorter term, MA, crosses above or below a longer term. A classic example is the golden cross, when the 50-day MA crosses above the 200-day MA. This is often seen as a very bullish, long-term signal. Conversely, when the 50-day crosses below the 200-day, it's called a death cross, signaling a potential long-term bear market. You can use this with any combination of time frames, like a 9-period IMA crossing a 21-period IMA, for shorter-term trade signals. Remember, crossovers are lagging indicators. They confirm a trend is already underway. They don't predict it. Next up, let's talk about momentum. This is where the Relative Strength Index, or RSI, comes in. The RSI is an oscillator that moves between 0 and 100. It measures the speed and change of price movements. Essentially, it tells you if a stock is overbought or oversold. The standard interpretation is that a reading above 70 indicates an overbought condition, meaning the price has risen too far, too fast, and might be due for a pullback. A reading below 30 suggests an oversold condition, where the price has fallen too much and could be due for a bounce. Now, a huge mistake beginners make is to sell automatically when RSI hits 70 or buy when it hits 30. In a strong uptrend, RSI can stay overbought for a very long time, and you'd miss out on huge gains. A better way to use RSI is to look for divergence. Bullish divergence occurs when the price makes a new low, but the RSI makes a higher low. This shows that the downward momentum is weakening, and a potential reversal to the upside could be coming. Bearish divergence is the opposite. The price makes a new high, but the RSI makes a lower high. This suggests the upward momentum is fading, and a reversal to the downside might be on the horizon. Divergence is a much more powerful signal than just looking at overbought or oversold levels. Let's combine what we've learned. Imagine a stock is in a clear uptrend, trading above its 50-day moving average. It then pulls back towards the 50 mega amperes. At the same time, the RSI dips into the oversold territory, let's say around 30. When the price touches the moving average and bounces, and the RSI starts to climb back above 30, that could be a hyperprobability buy signal. You're combining trend, a support level, and momentum. See how that's more powerful than using just one indicator in isolation. Okay, moving on to another crowd favorite, the moving average convergence divergence, or MACD. It sounds complicated, but it's really just built from moving averages. The MACD consists of three components: the MACD line, the signal line, and the histogram. The MACD line is typically the difference between the 12-period EMA and the 26-period EMA. The signal line is a 9-period EMA of the MACD line itself. The histogram represents the difference between the MACD line and the signal line. The most common signal is the crossover. When the MACD line crosses above the signal line, it's a bullish signal, suggesting that momentum is shifting to the upside. When it crosses below, it's a bearish signal. The histogram gives you a great visual for this. When the histogram bars are above the zero line and growing, bullish momentum is increasing. When they are below the zero line and getting larger in the negative direction, bearish momentum is increasing. Just like the RSI, the MACD is also fantastic for spotting divergence. If the price is making higher highs, but the MACD is making lower highs, that's bearish divergence. It's a warning sign that the trend's momentum is weakening. You can use this in conjunction with other signals. For example, if you see bearish divergence on the MACD while the RSI is in overbought territory, that's a much stronger signal for a potential reversal. Our final core indicator is Bollinger Bands. Created by John Bollinger, these bands consist of a simple moving average, usually a 20-period SMA with an upper and lower band plotted 2 standard deviations away from the MA. Bollinger Bands tell us about volatility. When the bands are wide apart, volatility is high. When they squeeze together, volatility is low. A common misconception is to treat the bands as simple, overbought, and oversold signals. Selling when the price touches the upper band and buying when it touches the lower band. This can be disastrous in a strong trend. During a strong uptrend, the price can walk the band, continuously hitting the upper band as it moves higher. A better way to use them is to look for volatility contraction and expansion. A period of low volatility, where the bands squeeze together, often precedes a period of high volatility and a significant price move. This is known as the squeeze. When the price breaks out of this squeeze, either up or down, it often signals the start of a new, powerful trend. You can also use the bands for confirmation. For example, in an uptrend, pullbacks to the middle band, the 20-period SMA, can often be buying opportunities. If the price falls to the lower band in a strong uptrend, it might be a sign of a deeper correction or even a trend reversal. Now, let's address the most important part: avoiding indicator overload. I've just given you 4 powerful indicators. You do not need to use all 4 on every single chart, all the time. The goal is to build a simple, clean system. A great starting point for beginners is to use 1 trend indicator and 1 momentum indicator. For example, you could use the 50 and 200-day moving averages on your chart to define the long-term trend. Then, you could add the RSI below your price chart to identify potential entry points based on pullbacks and divergence. That's it. Just 2 indicators, giving you a clear picture of trend and momentum without cluttering your view. Or, you could use Bollinger Bands to identify a volatility squeeze, and then use the MACD to confirm the direction of the breakout. When the MACD line crosses its signal line in the direction of the breakout from the squeeze, that's a powerful confirmation signal. The key is to pick a combination, learn it inside and out, and stick with it. Understand its strengths and weaknesses. Backtest it. See how it performs on historical data for the assets you want to trade. Don't be an indicator collector, hopping from one to the next, looking for a holy grail. The grail is in the mastery of a simple, effective process. And the best part, all the indicators we discussed today, moving averages, RSI, MACD, and Bollinger Bands, are available for free on virtually every trading and charting platform. You don't need to buy expensive, proprietary indicator packages. Tools like TradingView, Yahoo Finance, or the platform your broker provides will have all of these built in. Start with these free tools. Master the fundamentals before you even think about paying for anything else. So, to recap, start with the classics. Master a trend indicator like moving averages and a momentum indicator like RSI or MACD. Combine them to get a more complete picture of the market. Look for confluence, where multiple indicators are giving you the same signal. And most importantly, keep your charts clean and your strategy simple. Trading is about making clear decisions, and a cluttered chart leads to a cluttered mind. That's our deep dive into indicators that actually work. I hope this cleared things up and gave you a practical framework to start with. If you found this video helpful, do me a huge favor and hit that like button. And make sure to subscribe and ring the bell so you don't miss our future videos. What's your favorite indicator combination? Let me know down in the comments. Thanks for watching, and I'll see you in the next one.